Good morning and welcome to BQ Prime. We are tracking the big story. The RBI surprised the markets yesterday evening by increasing the risk weight for all consumer loans and credit card loans, with the exception of housing, education, and auto loans. This is a big move from the RBI, and it has come a month before the RBI policy itself. To understand what the implications are, what will this mean for the banks and what will this mean for consumer loans, we are now being joined by Mr. Ashutosh Khajuria, who is a very senior banker, veteran banker. He is the chief mentor for Federal Bank. Mr. Khajuria, welcome to the show and thank you so much for joining us.
Thank you. This is Ashutosh Khajuria, and I think very good morning to you.
Good morning.
You may continue, please.
Okay, so I also have my colleague Harsh Saita with me. He will also take the questions. But my first question to you is, Mr. Khajuria, do you think this is a surprise from the RBI governor? Yesterday evening, the RBI governor announced these measures to curtail the relentless growth in consumer loans.
See, I would not take it as a surprise because lots of hints were given by governor himself, and there had been some concern at regulatory level to just look at the system's the financial stability of the system and all. And if you have too much of unsecured consumption loans, personal loans are mainly consumption loans also. So then there is some concern at the at the regulatory circles. So that is something which he has been hinting about. He has been talking about the growing risk which is getting built up in banks' balance sheets if the growth is quite sharp. So I won't take it as a sudden knee-jerk sort of decision or regulation. The direction actually has come after a sufficient hint being given to the system. That's what my reading would be.
Right. So before I toss to my colleague, I'll ask one more question. Is this a system-wide problem? Because the measures are sweeping, it's going to cover almost every segment of the banking and financial services industry. Now, the RBI would have had the choice of going to specific banks with maximum exposure where the risk is very high, and he could have pulled them up. But instead, they have gone the whole hog and ensured that the entire system is covered. Does this mean that there is a brewing crisis here and some kind of a huge loan mela, if I can use the term, that has been happening?
See, I think you have to look at the background in which these personal loans and consumer, credit card outstandings have gone up and all that. There are 2-3 things which need to be appreciated. First was the pandemic, and as a result of the pandemic, there had been some fall in savings. Initially, the savings went up. People, saved to meet the uncertainties that would have cropped up, and particularly in the perception about how long this pandemic would last, what would be the after effects and all those things. So initially you would have seen bank savings went up. Nobody was ready to borrow and all. Particularly the lenders also were not very keen in lending clean. When I say clean is a word associated with risk in lending. Unlike clean versus dirty and all, here clean means you have no security in it. So therefore even lenders were a little circumspect about how much to extend their lending lines without security and all. And thereafter, I think when the you can say the bounce back happened post pandemic, I think propensity to consume more. So first they ate into the savings, and you would have seen the financial savings fell as a proportion to the GDP. So people started using their savings for consumption, for buying, for travel also would have consumed a lot. And as a result of that, I think there was a spree of higher personal expenditure expenditures also. So probably with that background, there was an opportunity for the lenders, and lenders made that possible by extending their hands into such products and all. So you would have seen the growth in credit card outstandings. You would have seen the personal loans coming in, BNPL, buy now pay later sorts of schemes, and lots of digital ways of delivering this product. So that had made it actually easier for consumers to go in for these loans. What regulation has done yesterday is basically to make it a little costlier by increasing the risk weight, and through that, what I probably regulator wants is the right pricing of the risk. There's basically a direction in which the regulator wants the lenders to move to have higher cost themselves and pass it on to the consumers to have right pricing of this thing, and that may also deter or inhibit some of the borrowers to retain themselves or contain themselves within their limits, also within their boundaries.
Right, Mr. Khajuria, absolutely. So let me try and take a cue from that. Would you therefore be alluding to the fact that there was some amount of mispricing happening in this particular loan segment, or these segments rather? And if I can also try to, along with this, club a couple of more first order impacts of this particular regulation that's come through. One is on growth. What you feel growth will therefore come off quite substantially right off the bat? And second, where will therefore yields start to go? Will they creep up by say 1%, 2%? Any broad quantification with regard to what your sense is? Right, I know it will just be back of the hand, but any view on that one?
See, I think I would see differently, because there are some banks with a larger proportion of their loans being in this category, beyond 10%, some even closer to 20% of their total loan book and all. Probably their base itself is quite high. So because base is high now, there would be a cost on it, higher cost on it, higher capital requirement for that. Maybe their pace of growth may recede a bit. But there are some banks who practically have started from scratch, zero. And I told you, because the propensity to spend was there, and there was demand for consumption goods and all. There was a sort of intent of competition to provide that. Now, when competition is there, that one upness and all sorts of things that come in. The price discovery actually happens. I won't use the term mispricing, but this is how the competition makes it for the benefit of the consumer, ultimate consumer. So the beneficiary here was the consumer segment, the borrowers, personal loan borrowers, and all that through this process of competition and all. So there was transparency. People were disclosing, you would have seen lots of advertisements saying that there are no hidden charges, sometimes, waiver of processing fees, and various things, various sorts of, I would say, marketing, so-called, initiatives taken by various banks to, allure customers to come to them. And in the, in such type of competition, the consumer is the winner. Probably, it could have been, may not be exactly in line with the risk, vis-a-vis the pricing of that, and probably that could have been one of the reasons wherein regulation has stepped in, or rather, regulator has to, come in and tell people to rightly price their products also. Right. Because from outside, you can see it in a better way, in a holistic way, and see what type of risk is getting built up in the system. Right. And if that type of risk is getting built up in the system, then there are, the requirements, or there are needs to, look at the corrective action, if I may call it so.
Right.
One question here. See, it's very clear that the banks have to now provide for more capital. They have to be more cautious. Assuming that the personal loans are going at a 12 to 14% rate, I will simplify this for the sake of the viewers. What will be the impact on interest rates for consumer loans? Will it go by 200 basis points? Will it go by 100 basis points? Is there a ballpark figure that you could give us?
See, 12 or 14 in isolation doesn't mean anything. Because when you have to talk of, when you are talking about 12%, 4%, you have to see it, what is the rate of growth at which the system as a whole is growing. You have to look at, the rate of growth of the system as a whole. So now if credit growth in the system is say 15%, I'm excluding, the NBFC merger with banking system, and we are just taking the ASCB figure, all scheduled commercial banks credit growth figure. If say that is closer to 15%, then I think 12% to 14% growth in personal loan doesn't create that type of, because it's in proportion to, it may not increase the pie of personal loan within the total loan book and all. But in isolation, what is the growth, or rather if we go more granular and see which bank is growing at what rate and what had been their total loan book growth, that would give a better picture about the impact and all. As a whole, if you see 25 to 50 basis points capital increase probably may not impact much, because this is 25 to 50 percentage, not basis point, 25 to 50 percentage points increase in the risk weight, and on that risk weight you have to maintain the regulatory capital and overall. Right now banks are very well capitalized. CRAR of some of the banks is in the range of 16 to 19%. And as a result of that, I think the immediate impact may not be there for going in for raising capital or so. But because the capital is getting consumed and all, the pricing may increase. That again would depend on which bank is sitting on what base. So it can't be uniform. It can't be uniform. Some banks may raise even by 1 percentage point. Some may simply have a 25 basis points increase or so. So I just don't want to give a particular number as such for the system as a whole as to by what range the pricing of unsecured loans would go up.
Right, sir. So point taken there. But within the banking pocket, I won't put you in a difficult position to name, but within the banking pocket, where is the largest risk in your view? The larger banks, private banks, the smaller, medium-sized banks, or PSU banks, or then there's a separate NBFC category as well. So where would you see a larger concern with regard to risk?
So we cannot categorize it in that way. I think you would have to go by the outstanding, or rather active credit cards, their number and all, and the portfolio. So you may have a public sector bank there, you may have a larger 2-3 private sector banks. So I think it's there in public domain. You can see who is having what type of portfolio, particularly in credit cards and all that. And same with personal loan.
Right. Okay. Thank you so much, sir, for joining us and giving us your expert view on this one. And viewers, we will continue to bring more expert voices on the show. Stay tuned. Thank you for watching from me and my colleague, Harshit.